Hello, everyone. Hello, Henrik. Good to see you again.
Good to see you, Jan.
And I want to actually pose a fundamental question because there's a lot of noise and chatter on Twitter. Like I'm a Twitter native. I've always, I think, become very literate financially, I think, through Twitter. But especially over the last couple of years, especially the post-COVID era, it's very difficult to ascertain what is actually true and what is only a actual perspective that leads to a specific type of outcome because there's a vested interest for that to be the case. And I think one of the goals of today's meeting, if you can't get anything else but this goal out of this meeting, would be to really try to give an objective perspective on the economy and on finances, and more particularly understand the differences between, a stock market going up and an actual growing and stably growing economy, right? So this idea between fundamentals and speculation, or finances and the economy. And I think with
Mhm.
that in mind, I wanted to basically start out with a specific view on that topic, which is basically this graph here. And it's a chart that you've shown a few times in your private sessions that you've had, that I've also lucky enough to be part of. But maybe for the audience, could you explain what this actually is? And we can maybe use this to set the foundations for this conversation.
Yeah, sure. But it really is what it says here in the right left-hand corner. We can see that it's forward earnings, S&P 500 versus the S&P air, freight, and logistics. And what we see is simply that what a lot of transportation people know, and we have a good client also who's in transportation, and he always lectures me on these things. And it's really a good input, because what he says, it's so visible to us that have been working in the transportation industry, to see that when you have a slowdown, you really start to see it in the transportation index first. And that is what we see here. So the air and freight logistics forward earnings, they start to say, okay, this does not look so good. And this is something we have seen into recessions, before the S&P actually catches up on this. So transportation leads, and we also had that on the Dow Jones. We had the Dow Jones transportation index always needs to support the move in Dow Jones or in the S&P and so on. And actually, we start to see that clear disconnect there, as we also see with this chart here. So and again, it's not my chart, so please make note of the source down there. But we of course use good information like this, and I have tested that and checked that these information are correct. But this is the view that we have. The economy is not booming as the stock market seems to suggest. It's actually coming to an end. Doesn't mean we're coming to an end now, right here, but the cycle is turning, as I see it on economic on a macro level.
And I think this is an absolutely key point because there's just so much noise around, even on the concept of a top, right? And what an actual global top and a global bottom, what that actually constitutes, what that actually looks like. And I think what we've learned over the last few cycles, especially let's say the 2010, which I think was a cycle that you were very, very keen on kind of debunking in a lot of ways, right? In the way that it actually played out,
Mhm.
especially as people recollect what actually happened through, the different kind of personal accounts, and also what
Mhm.
happened in 2020, right? And
Mhm.
I think what is really key in all of this is to really differentiate between the fundamentals and the actual speculation side. And I think this is one of the key reasons we also look at crypto, even though us as a fund, and I think also yourself, we tend to look at the broad market, right? We're macro people
Mhm.
at the
Mhm.
core. We try to
Mhm.
understand how these different assets tell us. It's kind of like a mosaic, and how they tell us something
Mhm.
about the fragility or the strength of the entire
Mhm.
ecosystem. And what we're
Mhm.
definitely seeing more and more of, and I think this is where crypto is kind of really telling in a lot of ways, is that something is fundamentally broken. The fact that you have
But before you
something.
go there, Jan,
Yes, sir.
before you
Go
go
ahead.
there, may I actually try just giving you another chart also similar to what we see here, but just another.
Yes,
So if you allow me just to
sure.
if I can share just a second here, because this is showing exactly the similar thing that we were just talking about. This is the JOLTS, the job openings, which we have here with the blue line, and then you have the S&P 500. And then we have the recessions here, and even the COVID here. And down here we have the unemployment level. And what we see every time that we don't have data before here, but we see it here, we have that both the job openings and the S&P, they kind of follow, but we have kind of a leadings on the job openings. You can see the job openings actually starts to decline here. And this is one thing. This is one of the dogmas that you see all the time. The stock market tells us where we're going. That is actually incorrect. And I would encourage everybody to that sits here and listen in now, study, look at what happens when the unemployment level starts to putting a rounding bottom. That is actually what we see somewhat here. You can see it down here as well. This is the unemployment level starting to put in a rounding bottom, and then the stock market actually puts in the top later on. But what we see now is a clear disconnect. The financial markets thinks everything is fine. The real economy, not so much. And also, especially with the unemployment level we see. So things are not great. And I think this is where I find it really difficult to discuss with certain people that think we're early cycle here. And I don't want to get into a nasty discussion. I actually just want to share these things on an open basis and say, you know, as I see it, the economy, the real economy, the consumer of the world, the US consumer is not good at this point. The labor market has started to show the signs, the weakness that we have been talking about that should start to show. And if you look to surveys, you can actually see that there are 15, 16% of the US population that now find it difficult to put food on the table. So this is actually about the big schisma here, about who's driving things. Is it the stock market? Or will it be the real economy? And I know where my bet is, my money's on. That is on the real economy, because by the end of the day, that's 70% of GDP. And we have seen it over and over, even though the stock markets have been making a hurrah into a large top and liquidity has been soaring in. We have always seen that the real economy is defining when we have a top in the market. So this here is a really big disconnect, showing again the same that we just showed with the transportation. Sorry, but that was just a supply, or an additional view on what you just.
And obviously, in today's webinar, we can't really touch on all the points, but I think there's fundamental shifts as well on the foundation level, right? There's things like the impact of AI in the actual job market. I see with many entrepreneur friends that I have that are seriously considering the marginal hire that they're attempting to do to be able to grow their business, and trying to understand if it actually makes sense or if there's room or space to actually fundamentally change the way that they operate by including AI in the process, right? So I think there's a foundational shift that is happening there as well, and it still remains to be seen how much of an impact that has downstream. But I think you are definitely right on the fact that we are, especially in the way that the unemployment rates and numbers are playing out, we are seeing a dichotomy that is playing out, right? Where things aren't the way that they look because of the fact as well that, yes, you have higher employment, but at the same time, you have many more part-time jobs that are coming through right? So that we're talking about quality of jobs as well. Agreed. Jobs that are not fragile to changes or large changes in the actual underlying, let's say, foundations of the economy, right? So I think that's also something that very often gets ignored. Yes. And that it's not just the number, but I think the quality at the end of the day as well.
May I just add a comment also to the whole technology part and the AI part? Because I think this is again where people say, yeah, but this, AI will help us. It's going to make everything fantastic. No doubt about that. I think AI is the greatest technology advance we have seen in a long time. We just need to control it so it doesn't run amok. But like what we saw, and it's not because you usually say, Henrik, it's because you can remember the 1840s when I tell the story here. But when you saw the railway coming out, the train, the locomotive back in the steam engine in 1840s, I can tell you there was a massive bubble back then. Thousands of companies were actually, arising based on that. Some of them even did not have any business plans, any ideas of what their path, the lines that they were going to make. But there was a run to it because the technology would change the world, and everybody was, thinking, okay, this is going to be great. They were right. But a lot of these, the vast majority of these companies in 150 years ago, 60, 70 years ago, collapsed and were, and we saw a big bubble bursting. Again, 1920s, what do we see? The radio, electrification, the cars. I can tell you that was a technology shift that had really, that's a big technology shift. Try imagine, now we say, but I can take my iPhone, I can get on the internet, and then I can actually, order something. Correct. Try imagine then back in the days where you could actually turn on the light all of a sudden, or you could jump into your car and you don't need horses in front of it. The whole line production was something that Ford introduced back in the days. I can tell you these are technology shifts of magnitude. But also there, we saw a massive bubble in the 1929. We saw that because technology does not guarantee return. It guarantees that we'll see a change to the world, no doubt about it. No doubt about it. But also like in 2000, did the internet change the world? 1000% it did. I mean, we're sitting here now having this conversation we wouldn't have had before in the non-internet world. It did. But it does, yet again, you had a bubble developing into it because people were front running this. So my point here is there is a magnitude, major shift technology wise, 100%. Also, digital assets and all this that comes out of that, there's going to be something I'm not clever enough to understand where and how and when, what, but that's going to make a big, big shift to the whole world. The problem is that if people are front running these things too much, and the evidence are there now, as I see it, well, then this, even a big shift to the whole world, to the how the technology productivity levels will not be able to sustain the expectations of what it's going to bring in terms of return in the stock market and so on. And I think that is the problem we have right now.
Yeah, I think you're fully correct, right? And we're obviously going to get a little bit more into the weeds here with actual graphs. But I think as we stay in the more philosophical kind of realm, as we kind of get closer to the actual point, I think investment technology does not guarantee a positive outcome, because I think like any technological shift, I think Elon Musk said it in the best way, it doesn't guarantee anything, but it's our fiduciary duty to make sure that the positive outcomes outweigh the negative, right? So it's always this dichotomy, this question of, can a technology be more positive than negative, right? Because it always has negative externalities. And I think to your point as well with AI, I think the digital economy, I think with things like the blockchain, which I think will have long-term impacts in the future, us with Swissblock and I think Glassstone being big proponents of that, you have to separate the speculation, the investment cycle from the actual underlying utility and the actual value add that it brings as it becomes fundamentally better than what exists, right? So I think the first kind of innings of that would be what we call the kind of the stablecoin revolution, right? Where it becomes exponentially cheaper to transfer money through existing and new rails, right? Which I think is very, very important to lower the marginal cost of actually and the frictions to be able to actually transact, right? Which opens the door to new possibilities, especially in the front of making currency not the only dimension of how we exchange value, but we actually allow the value transfer to become more multidimensional, right? Programmable money, all of these different concepts that are now really coming to the front. At the same time, we really are at the intersection of a lot of different things that are coming together. Like it kind of gets defined in the fourth turning for those of you that haven't read it, where you kind of always need like big evolutionary changes on the economy, the wealth creation side, etc. They come when you have an intersection point between multiple things, right? You have usually the convergence between energy innovation, transport innovation, and information fundamentally as well. And we are seeing that, right, with AI, blockchain, let's say digital assets as a whole. And then also I think on the energy side, you can argue that we're now getting full circle again with getting cheaper and cheaper energy through nuclear, right? Now it's being kind of depoliticized again. We can actually have a real discussion around the importance and the validity of it. So I think there are a lot of things coming through, but just because there are massive investments, right? Like in AI, where you have hundreds of billions of dollars being basically guaranteed as investments over the next 2, 3, 4 years, it doesn't necessarily translate further down the line to actual value creation in the economy, right? Value
Right.
creation here meaning actual real growth and real value add on the singular side, right? Of people increasing their purchase power parity, right? So their PPP, increasing the actual, let's say the actual quality of life, right? Reducing poverty, all of these different things that are fundamental. So I think it remains to be seen how that impacts, and we've seen this many times before, right? I think you've mentioned this many times, Henrik, that just because you stimulate the economy, that does not create demand, because demand is something a lot more complex than just having more money, right? It could be that there's a shock effect that people, just because they get more money, they start saving more. They don't spend, right? And you can see that effect all over the world. Look at Japan. Japan has been in a situation for 30 years where stimulating the economy with more and more money has led to more and more savings, not more and more spending, right? So these things are not linear. People are not linear, and that's where I think a lot of these dislocations really come from. So today's objective is really to kind of put things into those two contexts. There's a fundamental side, and we'll go a little bit into crypto as well in terms of how we analyze and look at things, but also really that dichotomy between investment and fundamentals.
Well, I think it's about first of all, there is an understanding that we need to have. If people think that the financial world runs the real economy, I mean, then it'll be difficult to talk into people because you'll be convinced that, whatever the financial world is actually doing, that will then have a positive effect on the economy, and you'll then be early cycle. That's what we hear now. I say it's different. And this is why I've been focusing on also with our clients to look at the structural things. If everybody here, look at themselves and say, what are the two main components of my economic life? That is probably their house and their job. If you look at their house and your job, it's probably there where you generate the most value in your life. Obviously, there are people also investing, but if you look at 70%, 80%, 90% of the population around the world, that will be the house and the job. So what you look at is how if your house starts to depreciate in value, or it will become more difficult to own a house, you'll start to feel that you are a little less well off, and you will spend a little less money. And this is why I look to the housing market as a leading indicator. Why? Because when the economy starts to boom, and it's been in a boom phase for some time, it can be 2 years, 5 years, 10 years, you see the yields, the interest rates going up, and the Fed is hiking. What that does to us, all of us, is that it lifts the water level for how much we need to earn in order to be able to pay our mortgage loan, our car loan, and whatever kind of loan we have. Or if you want to buy a new one, it'll be at a higher price. So what does it do? Accumulative around the world, it will put a dampener on the activity. We'll spend less money, and the money will circulate less fast. At some point, you will start to see that becomes a problem for the economy. And there is actually very, very clear charts that I haven't open here right here, but where you can see that for some time, we will see when the interest payments for people moving higher, and people will be able to sustain it to a certain limit. But all of a sudden, it starts to affect the unemployment rate. And that's where you have the unemployment rate starting to move higher, or not the rate so much as the level. Actually, the problem with the rate is that it requires the participation rate to be observed as well. And if the participation rate, you're seeing people leaving the job market because they can't find a job or for whatever reason, which is actually what part of this, what we see right now. We see the participation rate is getting dropping. That is a problem. So when I look at charts, and then I say that the first thing we need to observe, and this is the also in the business cycle. Let me just see if I can find it here. So there are different ways of looking at the economy here. And as I said, if you look at the housing market first, and there are many ways of looking at that. But one thing is to look at the NAHB, which I prefer to look at because it has a broader look at the housing market. It actually has a sentiment among builders of U.S. single-family homes, and is widely watched gauge of the U.S. housing sector, since housing represents a large capital investment and spurs additional consumer spending on appliances and furnishings. Housing market indices help to monitor the overall health, and that is correct. So when we see that the housing market starts to deteriorate because consumers actually are getting higher and higher yields, the yields were moving up into this level, then we start to see that this actually starts to decline. And at some point, the housing market, because it actually has a leading effect on the economy, people will start to spend less and less. It's also because we don't see that the yields are just starting to drop just yet. They are actually a lagging indicator, but get back to that. But what you see here is simply that when it's been declining for some time, you'll see that there is a bottom in the unemployment rate. This is because it's an inverted curve here. I just, inverted it so it's easier to see. And then again, into this top here, you saw we're moving up, housing market doing well. We start to see a slowdown, and the housing and the unemployment rate moves up. And when you have a really big crash in this, that is when you have the big rise in the unemployment rate. So the housing market is a leading indicator for what's happening in the economy. And everybody who tells me now that we are in early phase here for a new recovery, why is the housing market down here? I can tell you why. It's because the housing affordability is down the gutter. So nobody ever, a lot of people feel it very difficult to actually just own the house and having to refinance it. You don't need to take my word for it. You just look at the housing affordability index here. It's down at 94 now. And if you go back in time here, this is from Yadani.com. You can see how, if you go back in long time, you can see how we are, below into what we had in the poor 80s, that we used to call it. So that is not a good thing for the economy. And there's nothing suggesting that a housing market here is bottoming out. On the contrary, we have actually seen new lows coming to it. So, and the affordability is absolutely not rising here. So why would we think things are great? Because Nvidia earns a lot of money? Nah, I don't see that. And then what we also see, if you look to the housing market, is that if you look at existing home sales, And then you have a 4 million level right now at existing home sales at a time where the unemployment is low. That is weird because if you look at this level here, that is normally what we see that when unemployment is high. And this is actually at a point where the US population is at 340 million. So what does these chart tell us? It tells us that affordability is bad. People will not sell their home because they probably find it difficult to actually, buy a new home. And we know how that is actually leading the economy. So, and again, if we then go back to this chart, what is then going on? The economy is slowing. The real economy is slowing, and the market is just rejoicing because everything is fantastic. I just say again, it's back to the structural understanding of the economy and what comes first. And then it's also about understanding that it takes time for it to kick through to the unemployment rates and to the unemployment levels. And this is what we start to see now. There's a clear upward trend in the unemployment level here. There's no doubt about it. And we can take a lot of other charts. We can also look at, the people that talk about soft landing here. It said, well, we have had a soft landing like we had in the 1990s. Guess what? First of all, our business cycle indicator did not have a signal here. It had it for every time we have had a recession. So that's one thing. But secondly, if you look at this here, when the Fed started to cut up here and the yields were moving lower, 2-year yields, you had a hard landing here. That means that you had a recession because unemployment was moving higher. And we had a yield inversion, which is one of the leading indicators as well. Same here. The Fed was cutting because unemployment was moving higher. Here we saw it was moving lower while we were seeing Fed cutting. Yield inversion here, yield inversion, unemployment higher, and you get the picture. Look at what we have had here. The most massive yield inversion we have ever seen, which is a leading indicator. It's not the moment it inverts, it's the moment it uninverts and starts to spike again. That's the problem. Guess what? It's moving higher. Guess what is moving higher as well? Unemployment level. So if I look at this again, and I have to put my money to something, do I then trust what the financial market is telling me with NVIDIA going vertical in terms of, which we have seen before? I don't know how many of you guys that remember the .com days, but I certainly do. And if we look at the NVIDIA here, see, these were the good old days, right? Back the days where the Cisco was the greatest bubble in the world and actually the most valuable asset back then, the S&P. I mean, forget about it. We look at here. So again, bubbles occur. Bubbles is something that we see over and over and over again. Normally, when we see a new technology coming out, like what we have now with AI, but they burst as people become too enthusiastic and think that this is going to change the world. It's going to change it now. And then we actually understand that people have been front running it too much. And then it comes down in crashing, especially when the real economy rolls over. And that's what we see right now. And the problem is now that with our indicator, our business cycle model is telling us that we are getting closer to that point. And actually, again, if you'll bear with me for 1 second here, we have some other things we can also look at in terms of this is where we start to look at some of the imminent things we see. And if you look at this is the 1 month government bond yields. We start to see that they are actually starting to potentially break down in the way we only see when we get closer to a recession. We don't see it really in some of the other imminent indicators yet, but we are seeing it in some that is telling us we are not quite there yet. And this is my point also here, that people need to understand there's a difference between when the Titanic hits the iceberg. This does not mean that it was anything they could do. What can the Fed do? What could the captain on the Titanic do? Nothing. The ship was going to sink. That point we are past. We passed that in November 2024. Doesn't mean that it unfolds immediately. The Titanic took an hour and a half to sink. We're now in that zone right now where everybody seems to think, oh, the music is still playing. We can still go to the bar and get another drink. And, everybody seems to be, comfortable that things are fine. They are not. And this is what I see. And that's why I am very bullish right now, because I know in that phase that the central banks are coming in and trying to stimulate the economy, which they only do, not early cycle, by the way. They do that late cycle. And that is what we see right now. We see exactly the Fed is now starting to get the memo that the economy is weak and that the Titanic has hit the iceberg and they're going to come in big time. And I'm not sure the CPI number of today is going to be enough for a 50 basis point cut. But the labor market is definitely showing that they are so far behind the cycle here, or the curve.
Yeah. I also wanted to add a couple of, I think, key facts here that we need to really get straight, because I think we always have to look at the economy as a very complex, multifaceted thing, right? So we can't just look at a specific unemployment number, a specific inflation number, and just apply that holistically across everything. I think there's certain elements of the economy that get affected a lot more by a slight increase on prices, right, which leads to inflation, or a slight drop in actual overall housing wealth, right, because of the disproportionate amount of wealth that they have locked in that type of investment. So I would like to actually go directly into two questions that I just saw come through. One of them was from Cap 10. Goods economy that is measured by transport is getting smaller and smaller, as semis are becoming the new canary in the coal mine. How do you see the 600 billion upstream AI investment influence your forecast? That's question one. And I want to tie that into question two, which also talks about the wealth effect from Joel W. That's why housing is important for the wealth effect, but people with houses tend to have other assets, no, stocks, gold, assets, and have more liquidity in terms of their fiscal and financial, let's say what they own in that realm. Won't that affect negative wealth effect from dropping house prices? So to give you a couple of concrete points on this, if you look at the U.S. housing market, right, over the last, let's say, using end of 23, end of 24 numbers, right, you're looking at about $160 trillion worth of actual housing wealth, right? If you break that down between, let's say, the top 10, the middle class, right, which is, let's say, between the 50th and 90th percentile, and the bottom 50, the breakdown between housing wealth was, of the wealth that is actually tied to the actual underlying house, so the brick and mortar house that they're basically living in. The top 10% have about $18 trillion worth of housing. The middle 50 to 90th percentile have equivalent 18 trillion, and the bottom 50% have about 2 trillion. Okay. So the net effect of falling housing prices is obviously going to hit the middle class much stronger than the wealthy and the bottom, and the bottom 50%. And the reason for this is that of the $160 trillion of actual housing wealth that is there, so that includes all types of investments, liquid assets, housing net worth, etc., 38 to 40 trillion is actually in housing wealth, right? So if you do that relative conversion, the remaining, let's say, 120 trillion that is left is disproportionately going to the top 10%, right? That's why you're having this massive difference or dichotomy between people that invest and have access to the stock market versus people that don't, right? And that is also important to the first point as well, on the AI investments, and how that is going to trickle through the actual economy, because a lot of that investment is being priced in on the speculation side. So the actual future discounted value of these companies that are obviously at the forefront and that are basically net benefactors of larger investments. But it's not clear yet how that transitions into actual, let's say, middle class, blue collar jobs, right? Of the ones that say that are building out these actual large infrastructures, right, on the energy side or on the cloud, let's say computing, or let's say computing side of the equation, where the story is very different, right? So if you look at, let's say, the actual overall share of, let's say, the actual good side of the equation, only about 12 to 13% of the US non-farm employment. So, right, so we're looking at about 20 million of the total 154 million of total jobs that exist in the US. Only 12 to 13% are actually in the good side, right? If you look at the holistic top 10% middle class and lower income tax brackets in the US, whereas 87% roughly is in services, right? So we're looking at things like healthcare, education, finance, professional services, right? Also things like, let's say, leisure, right? Hotels, basically holidays, these types of things, right? Or basically on that side of the equation. But when you look at it specifically to the middle class, right? And why do we look at the middle class? Because that's where the majority of the average wealth, let's say, is in the US, right? Especially when it comes to housing, especially when it comes to the actual net spender in the economy, that number jumps up to about 25%. Okay. So it is disproportionately affecting the middle class a lot more than the overall impact that, let's say, the the goods and services side has on the actual real economy. And I think these are very important things to differentiate because we are seeing, and I think, let's say this graph that we showed at the very beginning, right? Just for those of you that joined us a little bit later to show that again, this graph here is basically showing you the difference between the actual middle class versus the people that have disproportionate access to financial services. So if you take one thing away is that there's a massive difference between the two. To give another example, right? You guys know that in the US, there's about 4.3% unemployment at its current state. If you look at new entrants to the job market, right? So people that are between the ages 18 and 25, right? So people that are about to join the job market that are maybe in college and all the way to people graduating from college, that unemployment number jumps to about 11%, right? So they're getting disproportionately more affected than people that have already entrenched careers and are kind of ready further on along in their actual career progression. Not the case for early entrants. Why is that a problem? Because obviously, if that issue does not get resolved at the top part of the funnel, that's going to become a massive problem once things like demographics really hit, right? So we're also at the cusp now of the actual acceleration of people retiring, right? So you have a demographic shift now of a financial system that requires new wealth coming through the system to be able to support, let's say, the political the decisions that were done 10, 20, 30 years ago, okay? So there's also that additional pressure that is there. And there's a lot of evidence to showcase that the new entrants into the job market are not really in a position to be able to actually do that, to support that system for the next 10 to 15 years. Kind of what Raoul Paul calls the debt jubilee type of situation, right? Where the government is going to be the buyer of last resort because they need to prop up pension funds to be able to actually pay out the political promises that were given much earlier in the cycle, right? So there's a lot of things converging, and we have to look at things with a finer comb. I think these generalizations become very problematic because it's clear that certain parts of the economy are doing well, especially where the 10% or the top 10% of the demographic is disproportionately getting benefited from higher asset classes, better access to financial systems, more easy access to credit, and in general liquidity, whereas the middle class is basically stuck on their actual house, right? So it's a lot of paper wealth, but it's not wealth that can be very easily dislodged because of the fact that also, and Henrik has mentioned this many times before, it's very difficult to sell a house currently because one, the demand for new housing and existing housing has gone down because the mortgage rates are very high, right? So it's disproportionately more difficult because you need disproportionately more liquidity to be able to actually finance a house to begin with, right? So a lot of people are just sitting on their actual wealth. And that will have a dragging effect, especially for the middle class when it comes to the marginal buyer of goods and services.
And it is about the middle class, and it's about the labor market in the US right now. And if you look at this also here, this is the average weeks of unemployment. You see here how the average weeks of unemployment is actually moving up. First of all, that's the one thing we only see into recessions. The way it's not a good thing. It's because people become more disconnected to the market. They find it difficult to find a job, and that shows right here. But what we also can see is that we are now at a significantly higher level than we were some time ago. Why? Because all the technology and everything that we are introducing to the economy is fantastic, but it's also becoming somewhat of a problem for certain people. There are people that simply find it difficult to find a job that they can handle, and AI is not going to make it much easier. And this is what we need to understand. It's not about the 1%, the 2%, the 5% of the economy, the people there. It's not about what NVIDIA can make in terms of earnings on AI and fantastic outlooks on this. This is about the 90% of the US economy, which is the labor market, the people, Mrs. Johnson there. And that is the problem. She's finding it difficult to support her home, to get the food on the table she needs.
Blue collar jobs, basically, right?
Blue collar jobs.
Yes.
Yes. And that is what we see right now.
Exactly. And to that point as well, there's actually an interesting analogy to this. When we had the electric car revolution, right? A lot of people were basically saying that that revolution was going to create a better, basically, overall impact or let's say positive externalities on the overall society, right? By reducing carbon emissions, by making cars, by reducing noise pollution within city centers, especially European city centers, etc. What people neglect to understand in that process or that transition is that the actual focal point shifted from the actual end generation of CO2 and basically strain on the energy grid to a different part of that supply chain, right? So very few people, for instance, know that around 35 to 40% of the California energy grid is actually powered by natural gas power plants, right? So large, very efficient, but very large gas turbine engines, right? So all of a sudden you have a bunch of electric cars that are actually being powered by gas turbines, right? So obviously there's a lot of political nuance there that wasn't really hashed out. At the same time as well, you put an energy grid to its knees, right? Because all of a sudden you have disproportionately more power stations, more required energy, especially in focal points where before the demand was not present, which creates all sorts of negative externalities. And I think on the AI front, we're kind of learning that process as well. We don't know yet what the actual requirement for energy is, and more importantly, where that is actually going to come from. It's definitely not going to come from renewable energy. I think the only solution there is definitely going to be nuclear, right? I think we need a nuclear kind of very strong bedrock and to be able to actually service the demand that is going to come through in the next 10 to 20 years. And also to that point, right? I think Henrik and I are very bullish on the positive externalities of AI, right? In terms of how that's going to increase and kind of facilitate more types of jobs, right? I mean, I see it in my own job. I become exponentially more efficient at reducing my day-to-day menial tasks that I spend, 4 or 5 hours on a daily basis that all of a sudden become 10, 15 minutes through specific prompts and agents, right? So there's definitely massive marginal opportunities that can be made there. At the same time, it's always in the transitions, right? So if you look at from more of a historical context, it's always in the transitions, in the volatile periods where the new jobs are not fully defined yet the old jobs are basically being eroded away, where you have a lot of social unrest, right? A lot of social instability and also economic instability, because the economy is transitioning to a new set of principles, right? On the economic front, on the energy front, transportation front, and information front. That's exactly what we're actually living through right now. And so when Henrik talks about, and when I talk about, a recession or a general kind of downward pressure on the overall strength of the economy, it's not because we are doom and gloom and we think that everybody's going to go to shit forever. It just means that what we're basically trying to prepare everyone for is for a more volatile, very extreme to the upside and very extreme to the downside type of environment as the market reprices expectations, right? Where expectations that were basically seen as much more imminent become more long-term, right? I'll give the example as well with crypto, right? When I started back in 2013, 14, and you would have asked me in 2025, where would we be? I would have thought that it would have already been incorporated into all of the different types of payment systems, that stablecoins would have been very, fully proliferated and something that was basically a staple day-to-day element of commerce and business. That hasn't happened. Why? Because again, historically speaking, people tend to always overestimate what can happen in 1 year, but they tend to underestimate what can happen in 10, right? And that's where the speculation versus the reality and that dichotomy becomes very apparent.
Should we get to more questions, John? Or?
Yeah, let's maybe get to more questions. Exactly. After this webinar as well, please send us your questions through email, Twitter, wherever, or even Telegram with some of you that are part of our Telegram services as well, so that we can create specific webinars on specific topics, right? So we can maybe go a lot deeper, bring in expertise. One of the good things of Willy's, my network and Henrik's network is that we have a very, very broad, let's say, crop to pick from, right? Like actual experts in these different fields that can come in and actually we can have an actual debate and a conversation with as well.
So a few questions on why then, I mean, if things are so bad, why then blow off top? Why is that? Because this is the problem with people being bearish. And we all know about the doom and gloom people that are there on Twitter that are saying this is going to be really bad. I have probably one of the most gloomy outlooks in terms of how bad it can be. And I don't want to share too much of that today, but
that's because you're the old bear, right? The old bear.
The old bear, yeah. I got hurt in 2008 and all that. Yeah, sure. But
exactly.
The thing is, there are many things why I think that. We will not get into that. But why then, not being bearish right now? Because simply of, what we have in terms of indicators telling us that liquidity is still supporting higher levels. Crypto is one of the things that is, as you usually say, the canary in the coal mine in terms of telling us when things could be topping out. We have some fantastic signal, framework there. In terms of levels, Fibonacci levels, on the S&P, on Nasdaq, on Bitcoin, and so on. So we have a lot of indicators telling us that this can actually push on. Maybe not in a long time. We don't
timing in terms of date is not what we really, but it's more about which levels we'll see and what is it that we need to see when the top is in. But for now, I'm extremely bullish. I mean, short term, extremely bullish on what we could see. And that is because of the liquidity. And what we see into every blow off top that I called it so long is that people start to think exactly along the lines of, oh, now things are all solved, or the Fed has got our back. What can possibly go wrong when the Fed has got our back? They will just print. And this is why I think this can actually end in a gigantic move higher. We have some levels that we look for, but we know that our indicators will tell us, okay, now things are maybe getting a little too frothy here, and this is probably the level where we need to get out. So people that are bearish right now and saying, you're so bearish, so why are you show me your shorts? And I'm saying I'm not short. Why would I be short into something that is going to explode, higher until that point where we see those indicators starting to flash? Then I'll shift my position and my stance.
And that's where crypto becomes, I think, again, to kind of not overuse the term, but the canary in the coal mine, because it is the most sensitive thing to liquidity expectations. So as soon as that starts changing, we will know that the underlying premise that this financial market is being propped up on is going to be pulled out underneath, right? Once that starts happening, we will know that there's going to be kind of the cracks that are clearly there and starting to appear, that are getting papered over, are going to become more structural. And our entire framework is basically built on that premise. So we're not in the business of predicting. I'm going to make that super clear. When we talk about short-term, mid-term, and long-term expectations, we're looking at liquidity, right? So I think in the same way that Raoul Pal and some of the other, even Druckenmiller, with like the really big kind of historical macroeconomists and macro investors are basically saying, is that there are going to be environments where liquidity gets, the mispricing that happens can create massive upward shifts and tailwinds for asset prices. And we absolutely expect that to happen, but that doesn't mean that things happen for perpetuity, right? And that's where understanding the coincident indicators and the coincident elements that impact that price development is super key. We do that on the crypto side with the different frameworks, right? The vector frameworks that some of you know. And on the macroeconomic side, it's really the business cycle analysis that Henrik does on the coincident leading and lagging indicators, right? Which give you a general sense of how the winds are turning, right? And once you know that the wind is turning stronger to the left and it stays there for perceived longer period of time, that's when things really start changing, right? So we're in the lookout for these things. We're not in the business of trying to predict when something will happen, because inherently in complex systems, you don't know these things. What you need to be able to do is to be aware and to be able to be prepared when certain scenarios start playing out, right? And that's really what we're in the business of doing. And that's why these conversations are super key. It's also why I think a conversation between Henrik and Raoul Pal, for instance, I think could be very valuable, because it allows you guys to see the different sets of opinions looking at the same thing from potentially two different angles, right? So it gives you a much broader set of information to be able to make decisions on and to reduce the noise, right? At the same time as well. Next question. Can you envisage a late stage blow off top without something breaking first? Absolutely, right? Liquidity doesn't solve the problem, but it increases the asset prices, right? So remember, nothing changes sentiment like increasing prices, right? So people can have amnesia about the actual real problems as long as their portfolios are going up, right? And then at some point, the soberness of reality kind of kicks in, and that's where the cracks and the structural problems are so devastating and so problematic that you can't really solve them, even with more liquidity, right? Because again, you have that change in psychology, right? Where more money doesn't solve your actual real world problems, right? It's kind of like the cancer patient, right? Just because you throw money at the problem doesn't mean that you're actually solving the underlying symptoms of what's actually going on. Same type of an idea. Why do you see a bubble and not early cycle when most of the big Mag 7 companies are allocating trillions of dollars each over the next 1 to 2 years to build power generation in the AI data centers over the next 5 years? That's a lot of Capex that you seem to be discounting. We're not discounting it. What we are arguing is that there is a short-term, mid-term, and long-term impact. Short-term, that mispricing is purely in the asset, in the future expected returns, right? So the discounted value of the actual investment and the economic value that actually generates, right? So not just the actual liquidity that gets injected in the economy, but how that translates to actual real world growth, right? That you will not know until about 2 to 3 years down the road, as that money, that investment starts trickling through to real world jobs, right? So blue collar, the middle class point that we made before, that's really where it's not clear how that is going to prop up and sustain the economy as of now, the real direct impact is definitely on the asset price. What do you think, Henrik?
No, right. I know. Nothing to add. Agree.
Example. Sorry, this is from Joel W. as well. Health of US consumers, Zeberg has said they are in poor shape, but many of the banks recently issued reports that say the consumer is strong and their credit performance is strong. Reuters, leaders from Bank of America opens new tab, Citigroup opens new tab, and Wells Fargo opens new tab, told investors this week that consumers were continuing to spend money and mostly pay their debts on time.
It's like this. How did you go bankrupt? Gradually and then all of a sudden. The problem is right now that the banks are looking at their books and are seeing certain levels and saying, oh, but they are within the limits of this, what looks good. Correct. But the time all of a sudden when things are starting to shift, they will no longer be. And if you look at that gradual movement, that's back to the saying, the quote there, then you will actually see that the delinquency days are moving up for a lot of loan types, and it's actually above the levels we had into the financial crisis. You're looking at the consumer sentiment; it's down the gutter. Powell was asked in a presser just 3, 4, 5 months ago, what is it that the consumer don't understand? Why are they so depressed on things? And he's kind of, yeah, we don't really know because the economy is strong, the labor market is strong. Boom. Then you got the labor market revisions. Always look at the consumer. Look at also the surveys on, as I said, for 15.6% of the US population can find it difficult to have severe problems in getting enough food on the table. That is the real consumer. So everything that the banks do is because it's within their limits. That's how they do it. If we have 0 to 10% or 0 to 20% within that red zone, things are good. We have most people in the green zone. That's how they report. And that's why you can't trust it, because the moment when it starts to slide, it can go really fast. And right now, there is no reason why businesses should hire more people, because the utilization of capacity right now is below what we have seen into any situation going 50 years back in terms of the utilization capacity they want before they start to lay off people. So this about what the banks are reporting, is simply, in my world, BS.
There's another, I think, structural point that we need to make always, right? We always have to remember that the entire financial and modern economic system is built on credit. So the repayment of debt is fundamentally not necessarily an actual good thing, especially when it happens in a disproportionate level where people use actual liquidity to pay off debt instead of actually creating new credit that gets kind of reinvested into the economy, right?
Good
So I
point.
think the key point here is also the rate of change in which that is happening. So as long as the repayment rate of change is kind of in lockstep or in a similar kind of acceleration, deceleration to the actual creation of credit, right, or the overall kind of growth, then that's fine. If there's key deviations there, that's something that we would have to look a lot closer in, because we wouldn't want an actual deflationary kind of cycle to actually take place on the credit side of the equation, because that would be a very bad thing for a kind of a credit-based economy
And actually, you're
as
touching
well.
on a very key point here, Jan, because the M2, everybody's pointing to the M2 as the reason why the Bitcoin is rising and so on and so forth. M2 is also credit, and in order to generate credit, you need people actually to take loans on and be able to do so. And if that actually starts to decline, as you said there, Jan, then it's out of the hands of the central banks. So this is what people don't understand. M2 is not something that the central banks are controlling directly. So again, the people's ability, the people's willingness to actually take on loan and start spending the money, even if they save some money now on QE or the rates are coming down or whatever, and we see yields are starting to come down. Then Mrs. Johnson, that has just found it difficult to pay her mortgage loan, and she's now 90 plus day delinquent on her credit card.
Yeah.
And she now saves $100. So Fed Powell then thinks she will go out and say, "Hey, I want to spend those $100 immediately, and actually, I want to take on another $100 in debt because I want to increase my consumption." That's not how the human brain works. She has seen inflation, she has seen yields going up, and she maybe have seen also her neighbor or her husband becoming unemployed. She's not going to spend that immediately. And this is the point actually to all the people who think that, oh, but they'll just print money and that's all fine. That will not hit the real economy unless Mrs. Johnson chooses to do so. And that's also why you see a diminishing return on QE and the rates cuts that you see, because money printing, interest rates and yields will not create real wealth, because you need the consumer actually to go spend that money. And if they start to sit on the money, which is a problem, then you can see that you actually have a non-reacting economy or less reacting economy to stimulus. That is why it's so dangerous for the Fed also to postpone this, because they are taking in. I mean, that's a variable. How much if you save $100 2 years ago when the situation was good, you could get a job anywhere. You're probably more prone to do it. But if you find it's more difficult to find a job, you'll probably say, "Hey, I probably hang on to that $100 for a rainy day if things are going to change." And there, by that, you're making the rate cuts even less effective. See, this is the psychology that changes also.
Yes, 100%. So to kind of add to that as well, is the blow-off top phase, do you see the market broadening beyond the max 7? Yes, absolutely. So usually the blow-off phases are also driven by rotation of capital. And you see that in the clearest way, I think, in crypto. That's the most direct and kind of obvious way of how capital rotates from lower risk to higher risk, right? So further on into the risk curve. I think you will see exactly the same in equities. Probably not in the same proportion, right? And that's maybe more of a question for Henrik in terms of how that can happen. But I think it's more of a broader effect as kind of general risk on behavior due to the expectation of liquidity coming through the system goes up. So I think, by the way, when we talk about short term, we really mean in the next 1 to 4 months, right? So that's really more on a macro level. That's what we mean by short term. Medium term is usually a year out. Long term is usually more than a year. Just to give a general kind of timeline as well. Have you quantified the limitation of the energy grid on AI growth? As we said before, that's something that we would need to kind of measure moving forward. It's still not clear where the bottlenecks are going to be. I think what is definitely fundamental is the kind of the reduction, not the fact that we can actually have an honest discussion about nuclear energy, where now isn't politicized in a way where it has been over the last 20, 30 years, especially post Chernobyl, right? Where it was used as an actual political tool and against communism and a bunch of other things. I think that is definitely going to be a key component of this, but it remains to be seen. We can definitely have more of a conversation in AI, and we can maybe bring an expert in that actually is part of the field, or a part of that field of actually building out the energy grid to give more information. And do you have a view on Europe, debt rising, modeling, or as usual, low dollar, low rates might help perhaps? Europe has always been lower growth, right? Just because of, I think, the social fabric and the way that the composition works. And I think even on a fundamental principles, ideals level, it's always going to be different than the US. Also, the fact that the US is a net exporter of dollar debt, Europe isn't, right? So I think there's like structural reasons for that to be the case. But I think Europe has a fundamental problem on a systems level, right? In terms of especially things like, or kind of the fault lines between Northern and Southern Europe, right? And how you have a monetary union, but not a fiscal union, and how that creates kind of irreversible cracks into the future that at some point are going to have to be faced and solved, right? Which we're just pushing the can down the road here. So also there, it's more complex. I think there has been a general unity versus certain fronts, right? So with Russia and Ukraine, I think that's created unity, but it hasn't been the case on all levels of the economy. So it remains to be seen how that plays out. Do you think Bitcoin will ever move from a SOV to an MOE or a U of A? So for those of you that don't know these acronyms, SOV is a store of value, MOE is a means of exchange, and then UOA is a unit of account, if I'm not mistaken. It probably will. I think this is a more fundamental question around the idea of pristine capital. So how does the economy, or say the ecosystem, perceive Bitcoin as a foundational unitary store of value, right? And once it gets perceived as such, it gets used as collateral in the creation of wealth, right? And basically in the backstop of TVL, these types of things. And it naturally then transitions into a monetary, kind of more of a monetary means of exchange, especially with large transactions, right? If I'm buying a house, a large boat, or whatever, probably Bitcoin is a better means of exchange and other things. But I don't think that's necessarily what it was built for. I think stablecoins are much more efficient on that front. I can just send you USDT, right? It's much cheaper as well. So it remains to be seen. I still think we're early on in that cycle. When it comes to unit of account, it depends on what type of company you're talking about, what jurisdiction. I think if you're dealing with certain much more proactive jurisdictions where Bitcoin can actually even be used to pay taxes, right? Where it actually becomes an actual legal tender, right? And at that point, you're probably dealing with something that is perceived as an actual unit of account, right? Where you deal in Bitcoin terms. But I think it's still too early for that in terms of mass adoption. But the trend is definitely more in that direction. I would agree. over the next 10 years? Are there any uncorrelated assets, or will everything just sink in a liquidity crisis or recession? So in terms of dollar terms, yes, right? It really depends on what your underlying kind of base currency is. But in dollar terms, I think things will depreciate because I think the dollar will inherently strengthen versus everything else. So you will have a general depreciation. But I think depending on how long this plays out for, I think there's going to be things that are going to be more valuable than others. Think of the Maslow pyramid, right? Where basic fundamental things become disproportionately more important than they are today, right? So think of things like eggs, right? Which in a normal running economy are very cheap. But if all of a sudden there's a supply shock and nobody has eggs in an economy that depends on basic staple goods, then that becomes disproportionately important, right? So probably agrarian products, land, these types of things become more valuable as the overall kind of speculative assets lose in their market share in kind of the asset bucket or pool. But I think it really depends. I would say that in this type of environment that kind of Henrik is pointing out, I think dollar is king. We're having, let's say, liquid cash is going to be king for sure. What do you think, Henrik?
No, 100%. I mean, I think there's a phase where people say which assets do you need to be in, and if you look at that, there you need to look to ratios. So you look at the SPX versus Bitcoin. You can look at SPX versus gold, and there is a special situation there where we actually have a crossover now. So gold is starting to outperform SPX in a way we haven't seen. We only seen 4 times this last 100 years, which is quite interesting. And it suggests that we have a market bubble, and it suggests maybe also some kind of distrust in the financial system, the monetary system. Interesting. But there is a phase also where the dollar is actually going to be the king just for some time. And I know that's not what people like to hear because right now it's been declining and we have all these good ideas of why the dollar is not a fantastic thing. It's still the cleanest shirt and it's because when it comes to currency, it's still the cleanest shirt around the world as I see it. And that means that it may be pretty dirty, but it's still the cleanest one. And in a deflationary phase where you have all the debt in the world, 60-70% in US dollars, you will have to see that unwind of the restructuring and if you get also a sovereign debt crisis, which I could see we could get easily, you would need to see that you will see that the dollar actually rises because of that crisis situation. That will not go on for a long time because the Fed will not allow that. And everybody can see that's a problem. If the dollar rises 10, 15, 20%, it's going to be really bad for the emerging markets and everybody else. And they'll get crushed under the weight of the debt, especially in a world that is soaked in debt. So that's why the dollar rise is more or less a given into deflation or into a bust of a bubble like what we have now. And I think people are missing that part. It's not that it's the long term and people start to become fundamental on it. That's a different thing. So the window for the bust of the bubble and hence the long dollar is where there is not much to go to. Everything that is denominated in dollars is going to have a bad day. Only, and if you say dollar, you also said US debt, and that means that there will probably be a good time for US debt for a limited period of time. Because I want to point out that Jeff Gundlach and others are now saying we have bonds are rising over the next many years, and they just give us the headlines as they see it. I see it in the way that yes, they are. We are in a new inflationary regime, which is going to be hard on the dollar at some point. But right now, in the short time frame, with a bubble bursting that I see, then you're going to see the dollar become everything for just a little while. So I would not be short the dollar. And I think we're closer to that bottom than people. I think there's a little more downside, but we're closer to it. And with that, if that happens, people will go 180 again in terms of the dollar, and then right into the top of that one. So we saw that also in January. Everybody was so bullish on the dollar. Then we saw, and we kind of expected it to decline. Then we saw the decline now because the body's getting so bearish on it, and that could be right into that bust of the bubble. And you want to be long the dollar there, as I see it.
And we're going to have a webinar next week, actually, with Willy Woo being present as well. And we'll focus a little bit more on the crypto side of the equation, liquidity expectations, and how that creates a flywheel into higher asset prices. Okay. So there are a couple of questions here specific to Bitcoin, Ethereum. Short term, I think the market always wants clarity, right? So the stock market always does well when there's clarity on the expectations that can be had about the future, right? Because remember, the stock market is always looking roughly about 3 months ahead. And that's why the FOMC is going to be very, very important, because it's going to set the precedents. It's going to set the rules of the game of how the next 3 months are going to start playing out. And I think this is really, really key for markets. And I think Bitcoin and Ethereum are going to be front running that significantly. I think what we saw today with the CPI, I think it again shows that we are not in a extreme inflationary environment like everybody believes to be for some reason. I think that there's good indication that I think things are really starting to fall into balance again when it comes to that short term. And I think a cutting regime into that brings up the Goldilocks zone. For better or for worse long term, obviously, again, complex systems, very hard to understand where we are mid or short to medium term. Long term, that can have obviously very bad consequences because of the job market. Again, things are starting to degrade on that front, right? It remains to be seen again if it gets contained or not. I think Henrik and I don't have some sort of like deviating belief there. I don't see the doom and gloom scenario yet, but I do see the degradation, right? Again, I'm more of a in the now, not looking forward, right?
But you're so young, Yann. That's why.
Exactly. That's probably part of the problem. But yeah, so we're definitely. I mean, I'm still a big believer in crypto short term. I think that is absolutely because again, the liquidity expectations are on the rise and they're constantly increasing. So I think that's a direct consequence of that. Once we enter the shift from bull market to bear market, what will you be shorting first? What are the high probability trades you'd be looking at time? The meme stocks for sure, right? So things that are highly speculative, that are kind of discounting future growth to the now. I think that's very, very important. I think staple, yeah, more on the growth story. So short growth and probably at that point, they consolidate into things that have more to do with basically constant that are basically good cash generators in good and bad environments, right? So companies that sell food, right? So the Nestle's of the world, these types of things are probably interesting to look at. Energy to some extent, not on the downside, but probably on the move up again. But like Henrik said, dollar, right? So long DXY as things depreciate versus the dollar. I think that's going to be an absolute interesting shift and dichotomy that then plays out again. And I think also gold, some people believe that gold is going to be doing very well if a recession does happen. Historically speaking, the sell-off in gold is actually the thing that indicates an actual recession. And the reason for this is that people tend to sell the liquid things in their portfolio to be able to actually shore up capital, to be able to do margin calls, to potentially counterweigh big losses that they have in other areas of the portfolio. So short term, not good for gold. As you guys know, Henrik is a big commodities proponent for the inflation part of the cycle when it does come, or the big inflation part. I think their gold has an absolute core mission to play, or kind of kind of a central kind of role to play. But I think in the sell-off, you want to be in dollars. Has your timing mentioned in the past few months, autumn 2025, for the crash changed? I think you're still roughly in Q4, right? At least the top.
I think it depends on, again, as I said before, I'm always asked it in interviews about when, and it's actually always been about the levels. So the levels will be there are levels that I'm looking for, and I could see that Q4, I could see them maybe even Q3 for some of them, but probably more likely Q4. And but the real thing will be when we see the recession. I mean, the indication of that, and that's what we have in the business cycle model, and the indication from our imminent recession indicators. Which, if they start to move really strongly and fast, then I'll be looking harder for a top, because they will tell us that, okay, guys, 1, 2, 3 months down the road, you're going to have a recession, and we know normally the stock market will then have put in a top before that. And again, we need the sentiment. We need sentiment also. There's also a psychology element to it when, I can start to feel that when I put something up. And I said it when we were at 4,000 in the S&P. I said, when I start to put some bearish tweets on X, and I get, punched in the stomach of how bearish I am and, gloomy and doomy, then I think the sentiment is right. We're not really there. I mean, I don't get enough. My bullshit indicator's not really flashing yet on on that side. So we need to have more of that. And so I don't think we're there yet. We have more, and that's why I say Q4 could be that. Let's see about it. Maybe I'll be surprised and it'll be a month or 2 or 3 later.
I mean, we have a lot of people in-house that are tracking all types of assets, right? I mean, from a systematic side, we trade basically, most of the global macro assets. We trade a lot of very strong equity presence as well, and crypto, right? So we're specifically kind of in line with how the liquidity kind of moves through the system. That's also on the crypto level what we focus on with the vector frameworks, right? So there it's really about understanding are we seeing the flashing lights or not? Like how's liquidity propagating through? For those of you that are following us or that are part of our advanced services, we've already been saying since 2 weeks that there's been a massive inflection point in Solana, right? So there's been a massive change in on-chain inflows of actual dollars coming from outside of the crypto universe into the crypto universe. And you're starting to see that as well in the actual price, right? So when it comes, I think, to Henrik's work and our work as a whole in Swissblock, it's really about looking beneath the surface. Like, what are the monsters that are kind of dwelling around that are going to have a positive or negative impact on the price at the surface, right? Which is what everybody else is kind of looking at and reacting to, right? That's why liquidity, structural analysis is so important and really looking at it through that perspective. So I think Henrik's business cycle and also the altcoin and the Bitcoin vectors are kind of the premise or kind of the beginning starting points, let's say, of that understanding, right? See, there's quite a few questions that came in at the end here. Let me try to go through the last ones. Let me see. What percentage decline is Henrik expecting on the various Max 7 stocks? And also, I think just to add it together from Bas K, do you think the housing market is going to plummet? And will it be a good time to buy, or do you see Bitcoin regaining itself after the recession?
Okay, that's a lot of questions. Let's do the
A lot of
housing.
questions. Yeah.
The housing market first. The housing market, I find it difficult to see how people can find it, affordability. We have this low affordability at this point, and we don't even see higher unemployment at this point. So if unemployment goes up, what I expect houses to, and people start to, be forced to sell because they simply can't afford to sit in their house, that's not a good situation to have. So yes, my expectation is, and if you look at the housing market, you look at Schiller's price index, you actually have a housing bubble that is bigger than 2007 and 6. So, and this is not something that people. So we actually have now both a tech bubble and a 2000 and a housing bubble, and that means you have the crypto. I would also say bubble. So you have there once a movie called the Storm. And the perfect storm is probably what we could be heading into. So yes, I think the housing market can decline as well. Bitcoin, what was the question? It was
Yeah, it's about the regaining, right? So Bitcoin, yeah, exactly. Yeah.
We'll have to see. I mean, technically, obviously, people will not like what if you're too bearish on it, and you will also tell me, Jan, we will have to see, and the framework will help us to guide us. Yes, I agree. We will need to see that, and I can see obviously there's a lot of adaptation in terms of institutions and so on, but that's not enough. Technically, I could see it dropping quite a lot, and it will have to prove itself if we get to that kind of drop. And if the dollar goes to the levels that I think the dollar can go to, can it sustain that kind of move in the dollar? Then fair. But if it takes the full beating of the dollar rising as I expect it to do, and the Nasdaq crashing, and Bitcoin is just, going with that, and actually, almost to a larger degree, to a leveraged degree, well, then I could see it become difficult for it. Not a popular answer, I know that, but let's see about it. It needs to show itself. It's not about when when times are good. That's not where you show strength. When you show strength is when the times are bad. And right now times are good. So everybody say hailing the Bitcoin for the next thing, and it's because everything is good. Show me strength into a very strong decline, and I'll be a disciple of it as well.
I fully agree. And it remains to be seen because we've not had a demand side recession, right? So 2020 was purely supply shock driven, right? If you kind of really distill it down to the fundamentals, it's very different, right? So the demand was always there. There was no real economic recession. It was just really more of a supply side thing, right? And I think we haven't seen what the actual reduction in demand looks like and how Bitcoin holds up, right? We don't know even, like Willy always says, it's a new macroeconomic, it's the newest macroeconomic asset. We haven't seen the full spectrum of its facades, right? We don't know how it deals with a lot of different extreme situations. And that's why I think to Henrik's point, once the dollar rises, I think it is a general risk off type of environment, especially when yields really start dropping off simultaneously, right? So we're really looking at yields dropping and dollar rising, right? Remember that what we saw November, December was dollar rising, but also yields rising, right? So it's kind of a big reason for that was again a repricing of different things due to Trump coming into office, due to repricing of future expectations. There's a lot of different things that were happening simultaneously. And that's more of an anomaly. I think usually when the dollar rises into the extent that it did November, December of last year, if the yields are also dropping, then that's not a good environment for Bitcoin. And I think that answers the last question, which is about the DXY. Well, where do you think the DXY will go over the next few months? I think to Henrik's point, the likelihood that it actually strengthens significantly into the end of the year, Q1 and Q2 of next year, I think is there. Absolutely. Also because a big reason for the de-dollarization has been politically driven, right? But then when push comes to shove, to Henrik's point, nobody trusts anything else more than the dollar, right? So I don't think the financial system is ready to adopt the ruble or the yuan as a counter or kind of as a safe haven, right? So yes, you can have certain small things like the Swiss franc, but even there, that has its limits. Also because I think if it hasn't already been, I haven't checked recently, but it was very close actually starting to have a negative carry because you actually have negative yields on the actual underlying. So that's obviously not something that you would want, especially if it goes to the extreme level of having, being a very negative carry type of investment. The dollar still looks a lot better. So there was one more about TLT and Treasuries will perform during the incoming crash. It depends what types of Treasuries, right? So short duration, if you just hold them to maturity, I mean, unless you believe that there's going to be an imminent default on the actual US government, there's more risky things than I think going to US Treasuries right now. And it definitely is an interesting opportunity. I think us as a fund, we're definitely looking into owning more, not less Treasuries, especially because everybody, again, to Henrik's point, when it's an emotional reaction, those tend to be good opportunities long term. Now, how that breakup looks in terms of dollars, euros, and francs in our case remains to be seen. But definitely, we're going to go more dollar heavy than we have been over the last 6 to 8 months. For those of you that joined, thanks a lot for the support. We will be sending this out, by the way, through email. So this is a recording that will be sent out. And as I mentioned at the very beginning, the next webinar will be with Willy Woo again, for those of you that asked. And we will be focusing more on the liquidity side of the equation, the structure, the vector framework, and also Hawkeye. And also maybe a sneak peek, Henrik, into the business cycle that you've developed, I think, because a lot of people have been asking for that.
It's the heart of things, right?
It is the heart of things, for sure. Thanks a lot, guys. And also thank you, Henrik, for joining, for taking the time.
Thank you, guys.
Before we begin, we do want to note that this webinar does not constitute financial advice. Everything discussed reflects only our personal opinions on the topic at hand. Always conduct your own research and consult a professional before making any financial decisions. Participation is clearly voluntary and information provided is intended for educational and discussion purposes only.